Getting ready. Getting ready to talk about today's personal finance in 3, 2, 1. Hey there, welcome to my live stream. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. Thank you so much for joining me. I know your time is very valuable, and it means a lot to me that you chose to spend some of it with me. We've got a few things to talk about. The stock market, investors are still on a high from the news of yesterday's infrastructure bill getting through, or yesterday's news about the Senate passing the infrastructure bill. In a couple of weeks, it'll move through the House of Representatives. Everybody's getting pumped on this, and you're seeing the results in the stock market. Certainly, the last few days have favored the reopening inflation trade, and that has continued to today. And I also want to talk to you about something very important about personal finance. You know how people are always saying to you that you should reduce your stock market exposure, reduce your risk as you get older? But do you ever wonder exactly why people always say that? What does it mean? I'm going to give you the real numbers to give you a true blue example of what it means. So we're going to roll the intro. It's going to be a good show. Stick around. This personal finance stuff we're going over today is the bomb. Here we go. Thank you so much for joining me. We are just getting started, and I want to thank you for your time. It means a lot to me that you are taking some time to watch and or listen to the live stream, Be the Boss of Your Money. If you have any questions, you know what to do. Hit me up in the comments. I love hearing from you. Words of wisdom, words of encouragement are always appreciated here. The live stream is called Be the Boss of Your Money. A little corny, I know. But I really mean it. I want you to be the boss of your money, and it's very easy for your money to become the boss of you. It's very easy to lose control, financial control. So maybe we should have called this mission control. I don't know. We could go on and on, but I'm kind of stuck with be the boss of your money. But I like it. I chose the name. I like it. Can't go back on second thoughts. We've got a few things to talk about. So let me know where you're watching from, by the way. I love to know that where you're watching from. I really get a kick out of this. I love doing this live stream. I've been a financial advisor for over 30 years, coming up to 32 years, actually. So I've learned a lot, and I spill it. I spill it all here. I just like spill my guts out with just everything I've learned. I share it with you because I love sharing, because the more value I put into the universe, the more value comes into my own personal universe, right? Isn't that how the universe is supposed to work? You get out of it what you put into it. So first thing we're going to do is this. The inflation figures came out today, and this is supposed to be like a watershed moment for investors, for the economy, for the Federal Reserve, for the markets. You know, we're all connected. All this stuff. It's like, are you talking about the stock market, the bond market? Are you talking about the economy, the Federal Reserve, consumers? There's so much to talk about, but I want to focus just on the economy. Inflation figures came out today. We're going to move along. The headline number was a little higher than expected. It's just like 0.1% higher. It's like 5.4%, okay, year over year. That was the expectation. It came out at 5.3, but the core rate, excluding food and energy, came out even lower. Now, I want to clear this up because I know what a lot of you are thinking. A lot of you are thinking that it's kind of sounds like a little bit too much bullshit to say the core rate. Well, we don't feel good about the rate of inflation. Did I just say that on a live stream? I apologize. I apologize. I didn't mean to say bull. But we talk about the rate of inflation. So, and then we talk about the core rate. And a lot of people think, oh, if you're stripping out food and energy, you get a lower inflation number, and that's better for the market. So you're just, cherry picking the number you want to fit into your puzzle piece of the world, to corroborate your view of the world. No. Let me explain something. No one's telling you to ignore food and energy. If you want to go by the raw number, the main inflation number, including food and energy for inflation, go right ahead. But food and energy prices are known to be very volatile. So they skew the number one way or the other. So if you strip those out, you get the core rate of inflation. I'm not saying ignore the raw rate with food and energy inflation. I'm saying look at both. But when we food and energy are the necessities. So you're saying, so we're paying more for the things that we need and less money for the discretionary items? Not really, because rent is a big part of the consumer price index figure, and that's going up a lot. So that's because just a shortage of housing, and that's why the price of houses are so high, driven partially by interest rates. A story for another day. So what we need to do is we need to understand that whether or not you like hearing about the core rate of inflation, excluding food and energy, it's the rate that the market goes by. It's the rate that investors go by. So if you're like me, you're investing for retirement, college, whatever it is, these numbers are important to you. I'm not saying they're the end all and be all, but they are very important. The other thing to remember is that the year over year inflation rate is moderating because we're going by a year ago. So the last few months of 2020, this time last year, we were at the peak of the pandemic, of the economic shutdown. And, we were just getting back on our feet as an economy. So now things have come roaring back in 2021, and you're seeing supply chain bottlenecks, and you're getting, a lot of inflation. But we're starting to moderate on that. For example, used car prices month over month from June to July, car prices were barely up. So these are the kinds of supply chain shocks that are starting to cure themselves. There's still a shortage of semiconductors, so it's still hurting automobile manufacturing, but even that's going to start improving pretty soon, if not already. So that's why the market went up today, because inflation wasn't too out of control. People are excited about economically sensitive stocks, cyclicals. We're going to go over this, but that's what moved the market up. The only thing that was really down today was the NASDAQ. So tech stocks were a little bit on the weak side. But I always say, you want to own the tech, you want to own the reopening trade, the economically sensitive stocks. It used to be that stocks like Procter & Gamble and Merck and Johnson & Johnson, those used to be considered growth stocks, and technology stocks were considered cyclical/value. Now technology stocks are considered growth, and the other kinds of stocks like healthcare and consumer staples now once in a while get to be considered value, cyclical. It's just everything is flipped on its head, and I think that's why a lot of people are having trouble figuring out this market. We've got somebody out there. Keith is out there. Hey, Mitch, watching you on the big screen. 65 inches of Mitch filling the room. Could you take a picture of that and send it to me? Because I got to see what that looks like. Maybe do a selfie with you in it. I would get a kick out of that. That is cool, man. Thank you. Thank you very much, Keith. I really appreciate it. By the way, Keith Wilson is on LinkedIn. Follow him. He's awesome. He's smart, creative, comes out with great content, and is a phenomenal financial advisor. Just the kind of financial advisor that lifts the entire financial advice industry. I have great respect for Keith Wilson. Thank you, buddy. So let's take a quick look at the overall market. We'll do a share screen. I'll pop myself up here. The Dow, I'm going to make this a little bigger so you can see this a little bit better on your smartphone, okay? Dow was up 220, new record high. S&P was up 10 points, new record high. NASDAQ was off a drop, no great shakes. 10-year yield has been going up a bit. It's off a touch today. I don't think it's anything of any concern. The 10-year yield, the 10-year treasury, our yields, okay, are very competitive compared to overseas yields. And I'll show you what I mean. Let's take a look at the bonds, okay? If you look at the U.S. 10-year treasury yield, it's 1.33%. The Germany 10-year equivalent is 0.46, and Japan is 0.03. UK 0.5, and France 0.19. So when you see the US over here at 1.335%, everybody wants to own our treasuries, which is why a lot of people aren't so worried about yields shooting up when the Fed pulls back on its $120 billion per month bond buying program, also known as tapering. Okay. So let's move on and we'll go to the watch list. We're really moving quickly, guys. So I appreciate you sticking with me. I would love, by the way, to hear I'd love to see your questions in the comments. Okay. But let's take a look at what did well. Well, the tech industrials did very well, but let's go into the sector ETFs. Building materials continuing its trend yesterday, up 1.4%. Industrials leading the way. Financials, I always tell you, when you see materials, industrials, financials, and over here, energy going up, that's a real sign of confidence, of investor enthusiasm for the economy. And if you think about all the jobs that are going to be created from this infrastructure package, I got to tell you, I think this infrastructure package, not the biggest package. I mean, $1 trillion is huge, don't get me wrong, but this is so significant. And if you are thinking, whatever, $1 trillion, no, you're thinking wrong. The amount of jobs, this isn't like the CARES Act or the PPP loans or the other stuff that we've been getting. This is creating solid, serious paying jobs. All right. So the bottom of the pack was healthcare, and technology was up a drop, even though the NASDAQ was down. So let's take a look at why the NASDAQ was down. We've got to always go to the FANG M stocks because these companies are so big. They always tell you a story. Here we go. Look at all my lists. Okay. So Apple was up a tiny bit. Amazon was off. Facebook off. Google off. Microsoft a tiny bit, but NVIDIA down over 1%. This is why you're not seeing the NASDAQ rallying to new highs, because without these 6 stocks going higher, it's really impossible for the NASDAQ to keep going up. These companies represent such a big part of the NASDAQ composite, the NASDAQ 100, and the S&P 500. So if you aren't seeing these stocks hitting highs, the S&P is kind of lost. These don't represent first of all, these are not all in the Dow Jones. I mean, Microsoft is in it. Okay. Apple is in it. But the Dow has more sensitivity to financials and industrials and other stuff like Home Depot and Caterpillar, which were big winners today. If you didn't notice, I'll show you what I mean. Let's see if I could pull this up here. U.S. stock. I'll show you the Dow stocks from best to worst. Here, let's get to that. Here, pop myself up in the corner here. Okay, let's go by percentage change. So the best ones: Caterpillar up 3.5%, Walgreens, Dow, Home Depot, Boeing up. At the bottom of the pack, Visa, United, Nike, Salesforce. Don't get me wrong; these stocks have had big runs, but you had 1, 2, 3, 4, 5 stocks that were off a little bit in the Dow, but 25 stocks that were up in the Dow. No wonder the Dow was able to hit new highs. Okay. Now I want to move away from just the stock market, but just so long as you know what's going on, okay, that that the market is moving along. Investors are enthusiastic as all can get out because of this infrastructure bill. The Fed is doing the right thing. You see, when inflation came out today, it didn't spook anybody because it was a little bit lower than expected. And the year-over-year numbers, because we're comparing a year ago as March, April, May, June, July, as those months roll off the calendar a year ago, we start comparing, let's say, November of 2021 inflation to November of 2020 inflation. The rise in inflation year over year won't be so dramatic. So that means inflation's moderating, the pace of inflation is slowing down, and it really reinforces the Fed's view that maybe not all, but a lot of inflation is actually transitory. That's the key word. It's transitory. I mean, if I sound a little bulled up, I'm just going by the news. I'm giving you what I'm looking at. All right. Now it's time to do something a little different. I have a little special surprise for you. we're going to talk about, you ready? We're going to talk about personal finance. Here we go. Personal finance. You want me to do that again? Was that cool? Here, watch your ears. This is kind of loud. I'm working it. You know, I'm trying. I'm putting the show together. You have to have the transitions into stuff. You want to see a really cool transition? Watch this. Watch this. You see that? You see that, Keith Wilson? Go back to screen. Oh, go to screen camera 3. See that? That slide? Oh, yeah. All right. So we're going to talk about personal finance. There's something that I really want to talk to you about. Philly, thank you so much, man. Wow, I love that music. Thank you, my brother. My handsome brother from another mother. Philly, by the way, was my guest about 2 weeks ago, all about crypto. I need that soundtrack legit. I want to do some aerobics to that song. You got it, buddy. I could get it's like a 3-minute song of just pumping out. Like I could see moving to it. Absolutely. Aerobics. You're like the Phil Simmons of the 2020s, man. Awesome. Okay. So let me put something on the screen here. Put this on the screen. You know, I'm going to do a share screen. That's going to be better. Okay. So let's get the brand. This is really important. You know how you so often hear how you're supposed to reduce stock market exposure as you get older, or as your kids get to college, you're in an age-based portfolio. So your 529 plan for your child gets more conservative. It goes from more stocks to less stocks, less bonds and cash to more bonds and cash as your child gets closer to college. There's a reason for that. There's a reason why we don't just go all in stocks and stay all in stocks. And you could say, yeah, but over the long term, stocks have always recovered and move higher. Well, first of all, I want to just change that for a second, okay? Individual stocks don't always recover. The indices, the stock market indexes, have always recovered. Now, an index, like the S&P 500 index, it's an index. You cannot invest directly into an index, but you could always invest in a security that tracks or mimics an index. But the indexes, they recover. In the year 2000, Lucent was one of the most widely held stocks. Every day, the New York Times in its business section would have a little section, the top 20 most widely held stocks in accounts held at Merrill Lynch. And it went on for that, I don't know, it must have been for like 50, 60 years, right? And one of the top 3 stocks, I think number 3 in the list, it was Lucent. Lucent was $100. It's maybe $1 today. WorldCom went out of business. They went bust because it turned out it was fraudulent. And that was a top stock to own. All right. So was Dell, by the way. And Dell did very poorly to finally were taken private. I know they're public traded now, but it's not the same thing. So stocks don't always recover, but indices do. But what I want to show you is one of the most important things you're going to hear about in personal finance. Okay. So I want to do if I pop this up, can I put myself over here? Okay, yeah, you know what? I can do it like this, okay? I'm kind of cut out a little bit, but I'll move over for you, okay? This is not the view that I want to do. So how do I get rid of that? Okay, so maybe if I do this. Okay, so here's what I'm going to do. Just stick with me for a second. This is Mr. Unlucky, Mrs. Lucky Distribution. Watch this. Okay, I'm going to make this a lot bigger. You're going to see this. You're going to see what I'm looking at. This is like true personal finance and what financial planning is all about, okay? Let's go to that screen, pop myself up here. This here is Ms. Lucky. Okay. I hope you guys are still out there watching this. I mean, this is important stuff. Okay. The reason we talk about us financial advisors about reducing stock market exposure as you get older, as you get closer to a goal, the most common goal that we talk about is retirement, either preparing for retirement or living in retirement. So before retirement, you're in the accumulation stage. And after you retire, you're in the distribution phase. But that 5 or 10 years before retirement and that 5 or 10 years after retirement, that's a critical time when something called a negative sequence of returns can literally trash your retirement. So in a $100,000 portfolio, we have Ms. Lucky over here. Beginning, you could use $1 million, you could use 5 million, 10 million. It's just the percentages that I want you to take a look at. Okay. So let's say beginning value of $100,000. By the way, this does not take into account fees and taxes. And I'm not your CPA. I'm not your tax advisor. I have to say that. I'm not your mama. I'm not your papa. Just so to make sure we're clear that you know me, I'm Mitch, the financial advisor who's been doing this for over 30 years. I'm so glad you're watching me today. Thank you very much. All right. So $100,000. And you're going to take $6,000 out of that account every year for the next 10 years. Now, let's say year one, you retire, you've got your $100,000 portfolio, you're going to take $6,000 out, but the market goes up 30%. So you take your $6,000 out and you've got $124,000. You see that? Okay, pretty good. You took $6,000 out. You're still way ahead. Okay. Let's say the next year the market goes up 20%. So 124,000. Okay. Goes up 20%. You take 6,000 out. Now you're at 142,000. So you keep taking 6,000 out. And look, see, the market goes up 10, up 10. Year 5 up 10. Year 6 up 10. Year 7 up 10. Year 8 up 10%. Year 9 and year 10. Market goes down 20% to 30%. That's a big hit. 2 years in a row. That's a big hit. But at the end, you're still left with $105,000. So you took out $60,000, but you're still left with over $100,000, $105,544 to be exact. And that, my friends, is why it is so important to not get caught up in a negative sequence of returns. I keep saying negative sequence of returns. What do I mean by that? What I mean by that is when the early years of your retirement, right when you get started, if the market goes down, if you flip that chart, I'll show it to you in a moment, it would have a very, very negative, severe impact on your wealth after 10 years. And the reason is you have to sell more shares of your stocks or mutual funds or exchange traded funds to pull out that same amount of money, in this case, the $6,000. So let me show you the other one, okay? Ms. Unlucky. Okay, I'm going to make this a little bigger for you before we pop it into the screen. All right, we're going to do share screen. Pop myself up here. Now let's take a look at Mr. Unlucky. Same deal. Starts with $100,000. Year one, Mr. Unlucky takes $6,000 out of his account, but the market went down 30% that year. So now, as a result, Mr. Lucky only has $64,000. Then the market goes down 20%, down to $51,000 beginning value, takes out the $6,000. Now you have $45,000. And even though you go into 8 years of solid gains, even the last year, 20% up 30%, taking out $6,000 a year, at the end of 10 years, Mr. Unlucky is only left with $38,898. And that's what happens when the market goes down early on in your retirement. The worst time, when you're investing for the long term, there's no best or worst time. There's really no best or worst time for an up market or a down market. It's luck of the draw. There are going to be some years you get a down market if you keep investing. Good for you. If you get an up market, well, at least what you've already invested is growing, but your new money coming in will be buying fewer shares because the market's going up. If you're investing into the market the same amount of money year in, year out, month in, month out. Okay. So what I want to do is put these side by side. Okay. And I want to take this one and I'm going to make these a little bigger so that you could get a better view. Oh, this is working out really well. I got to tell you, I'm like really proud of myself. Is it okay if I'm proud of myself? I'm like, well, that's a little too much. I'm just very proud of myself right now. Okay, so here's the difference. The left one, okay, where it starts with 100 and ends in 105,000. See that? And you see these numbers from positive 30 to negative 30, positive 20 to negative 20. It's the same exact numbers, except they're inverted from the positive gains to the negative losses. And this is what I mean. The most important thing is why we tell people, why we advise our clients, us financial advisors, to become more conservative when they start their retirement, when they get closer to retirement. At that point in their life, we advise having cash on the sideline, withdrawing some money out of the stock market, pulling some money out. This is like the international sign language for pulling money out of the market. Pulling money. You want to get a different view? Here. Pulling money out of the market. Okay, we're pulling money out of the market. Get me back to that, okay? Because if the market tanks, and let's say your expenses are going to be 70, well, in this case, you want to take that $6,000 out, but let's use a real life example. If you need $75,000 to pull out of your investment accounts in your first year of retirement, you want to pull that out before you need it, a year, 2, even 3 years in advance. I could argue for 5 years in advance. The reason being that if the market does tank, once you retire, you'll have the cash set aside, so you won't have to take out that $75,000 after the market tanks and then sell more shares of your stocks, exchange traded funds, and mutual funds. Because if you do that, you're going to have less shares in the market working for you the next time the market goes back up. And you could never catch up that way. That's why a negative sequence of returns, as opposed to a positive sequence of returns, is such a big deal. And that, my friends, is why we always say you want to raise cash, reduce risk, take some money out of the stock market well in advance of needing it. I'm going to show you this chart. One more thing. There's just something I want to emphasize. Okay. For the first one, $105,000 based on this particular set of returns. Positive 30 at the top. See the chart on the left, that's Ms. Lucky, and negative 30 at the bottom there. This person still has $105,000 after 10 years of taking out $6,000 per year from their account out of the stock market. But if you go to Mr. Unlucky on the right, same thing, started with $100,000, taking out $6,000 per year, yet that person is left with only $38,898 at the end of 10 years. Why? Just because the sequence of returns was flipped. Instead of having the positive numbers in the beginning, the positive stock market performance, this person had the negative stock market performance in the beginning. And that is what crushed this person's retirement. And that's why they end up with almost nothing. I should say almost nothing. They end up with less than 40% of their money at the end. And yet the person on the left has even more than that person started with, and they could do this again for another 10 years. That's why it's so important to reduce risk, take money out of stocks well in advance of a cash need. Thank you so much for watching. I really appreciate you, and I'll be back tomorrow with more about the markets, the economy, personal finance, investing. You know it. I'm going to cover it all. I know it. You know it. We're going to know it together. Thank you very much.